You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The nice thing, if there can be one, about this threatened pandemic is it might bring base metals and industrial materials down to the price where they're really, truly, stupidly cheap. So it could be that we could, as a group, enjoy a 2 or 3 or 4 year bull market in precious metals, and maybe 1 or 2 years into it, the recovery, the beginnings of a bull market in industrial materials. I'm not saying that's going to happen, but the idea that we face a bull market and then a bull market is, at the end of my career, which is what I'm at, an extraordinarily pleasant set of circumstances to look forward to.
Thank you for tuning in to another Mining Stock Education episode. I am your host, Bill Powers, and I am reporting from the city of Toronto in Ontario, Canada. I'm here attending the PDAC, the Prospectors, Developers, and Association of Canada. However, I'm not at the convention center right now. I took a nice walk in the rain down to the Sprott headquarters here on Bay Street in order to speak with Rick Rule, and he is the guest that I bring you on today's show. However, I did want to make you aware that my friend Brian Lenny of JuniorStockReview.com just launched a premium subscription service. Go over there and check it out. Brian is an engineer by trade. However, he discovered mining stocks over a decade ago, ended up selling his house to prepare for the expected upturn, and then taking the majority of the capital from the sale of his house with his wife's permission, tripled that money in 2016, and that launched him into a full-time career of investing in junior mining stocks. That's the means by which he supported his family, and now he has launched a premium subscription, and he is giving my listeners 40% off for the month of March only. If you use my last name, Powers, P as in Paul, OWERS, you can get 40% off of Brian's newly launched subscription service. A number of you have been emailing me, asking me to comment on specific companies and your portfolio, and I'm flattered that you would reach out to me. However, I'm not a financial advisor, nor do I feel qualified to give all of my listeners advice on specific companies. However, I am sitting down with somebody today whose company does offer that service. And if you want to email rankings@sprottglobal.com, Rick Rule, the company he works for, rankings@sprottglobal.com. In the body of the email, put the ticker symbol and the name of the company. Don't send an attachment, but if you put the ticker symbol and the name of the company to rankings@sprottglobal.com, Rick and his team will respond and give you feedback on your portfolio and the positions that you have. So Rick, thanks again for joining me today. As we saw gold stocks sell off last week, I'm interested to get a broker's perspective. Do you feel that you have education is a big part of what you do at Sprott, your clients enough to where you won't get the panic calls on a day like last Friday, or how do you feel that?
We have enough clients that, of course, we get panic calls. We also got clients saying, I've been waiting for this now for a year and a half. Let's go to work. So we get both. The truth is that unlike most of our competitors in the mining stock business, we continued to build and expand for the last 10 years. The consequence of that is that we have lots of clients, big ones, little ones. To paraphrase the movie, The Good, the Bad, and the Ugly. Was there panic? Absolutely. Was there ambition? Absolutely. Lots of both, and that's what a market's about.
When your brokers advise your clients, do they generate a specific potential buy list for days like we saw on last Friday?
No, because there is no one size fits all. We have clients for whom probably only the best and the most liquid names are suitable. We have some clients that I even advise not to buy the ETF, not to try and achieve market beta, but rather to buy the 4 or 5 best stocks in the world, which is safer, in fact, than the ETF. We have other clients who are hyper speculative. So the idea that there would be a top-down driven buy list at Sprott in its existence would obviate the best part of Sprott, which is the salesperson looking at the individual needs and prejudices of the client and employing all of the intellectual capital at Sprott to create bespoke investment solutions, which is what we try to do. I have been part of brokerage firms before that had, if you will, top-down intellectual management. And from my point of view, that's corrupt.
I know from talking to a lot of the brokers that do work for Sprott, you do a lot of fundamental bottom-up analysis, but the technical people that work, that do technical analysis at Sprott, do they feel like there was permanent, or at least in the short term, damage done from a technical standpoint to the sector?
I think there's no doubt that there was technical damage done to the sector. The truth is, however, that technical analysis is in many ways, particularly when the market volatility is the way it is today, partly a function of polishing the hell out of the rearview mirror. And, you can have a rebound, and I'm not saying you will, you can have a rebound that can obviate whatever technical conclusions one drew in very, very quick fashion. The VIX, as an example, trading above 30, is almost historically high volatility, which means that the technical analysis in this type of market probably is rear rather than forward-looking.
Rick, I've heard you say on numerous occasions that a small mine or a small project has all the potential hiccups and problems of a big project, yet it doesn't possess that big potential upside. So in light of that statement and truth, my question is, when you have like a small producer that maybe is bringing some old heaps into production, and they are, or maybe a small deposit, and they're self-funding their exploration, and the majority of the upside that they present to the market as a potential value proposition deals with the exploration upside on a non-dilutive basis. Even though they're a smaller company, would you go for one of these?
Very, very, very infrequently. Maybe if it had the name Mandalay in front, where they had done it in the past. In my experience, Bill, the skill sets involved in exploring and then building and then operating are different skill sets. And the idea that I would have sufficient intellectual capital in one wrapper at a general and administrative expense charge that I could afford, small. It's happened before. Certainly Glamis was built in that fashion. Certainly Rare Rock Yellowknife was built in that fashion. Certainly Mandalay was built in that fashion. But the fact that I've been in the business 45 years and I know 3 times it worked, it tells me something about the probability that that's going to work out for me. I am interested in established small mines if I have reason to believe that they'll be consolidated. That is, if I have reason to believe that the management team has the investor's best interest at heart, rather than their own salary and emoluments at heart. Unfortunately, those are very rare too.
You've been on record saying that when you do a private placement, you want the warrant for that additional upside. However, there's those that argue that they don't want to participate in private placements with the warrant. They would rather have a deal done at a discount to the market, so that there's not the warrant stripping that occurs after the 4 months is off, and that there's less dilution. What would be your response when you're dialoguing with those people?
I think they're both viable strategies. The people who don't want warrants are, for the most part, traders. People who are interested in short-term price escalation, and the warrant, of course, serves as a damper to that. If your orientation is a $25,000 position or a $50,000 position, a sophisticated high net worth investor's position, I can understand that. My job is to move the dial at Sprott, which means that typically I'm taking $1 million position or a $5 million position. So liquidity means less to me because I can't employ it. I have to be right, not right in the market. And the process of being right in exploration is that you have to be wrong a few times before you can be right, which means that your winners have to amortize your losers. And the best way to do that is a warrant. So I can certainly see from the point of view of a technical trader or a stock trader, or somebody whose orientation in the stock is 4 months or 5 months or 6 months, why you would object to doing a warrant deal, because it puts a cap on the stock. From my point of view, where the liquidity and the trading characteristics matter less, and success or failure matters more, warrants amplify my success. I have to have them.
Have you done a study regarding the private placements that you've done with warrants and how many times you actually got to exercise those warrants?
Yeah, of course that depends on the market. There are circumstances in a good market where you've heard me say in the past that I'm interested in the value of the unanswered question. There are times in the past in bull markets where stocks have achieved valuations that I would have expected after getting the answer to a question before the question was asked. Wonderful, wonderful, wonderful circumstances. And so in those markets, sometimes the warrants have been an absolute gift because nothing happened and I still made money in the warrants. There have been other markets where we have done everything right, enjoyed exploration success, and the warrants have still expired worthless. There are circumstances from my past. I'm thinking Francisco Gold, Pan American, Silver Standard, where warrants probably generated 50% of the return on capital employed that we enjoyed. If you think about the simple arithmetic, a dollar stock with a $1.50 warrant that enjoys exploration success and goes to, say, $5, you have $4 worth of profit on the primary stock, and you have $3.50 on the warrant that, in effect, you didn't pay for. It turns, a 4-bagger into a 7.5-bagger. And statistically, when your expectation is failure, which it is in exploration, that's the difference over time between an acceptable rate of return and an unacceptable rate of return.
We'll be right back after this word from our sponsor. Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com. You point out frequently the excesses in terms of general and administrative fees that pre-revenue explorers engage in, spending a lot of their money not in the ground. On this show, over the years that I've been interviewing people, I've been told that 80% of the money should go into the ground in an ideal situation. When you have invested in those explorers that have made significant discoveries, what percentage of their expenditures would be in G&A for those successful explorers?
Because of the increasing expense running a public company, we tolerate up to 25% of total expenditures in general and administrative expense. What we're interested in is the part of general and administrative expense that goes into executive salary and emolument needs to be proportional to the equity interest that the management team has in the company. If the managers own very little stock, if their equity is by way of options, and they're getting paid a lot of money, they aren't incented to achieve. They're incented to exist. And while their existence is interesting to me, it's not important to me. So we're interested in the distribution of their benefit, if you follow the way I'm going. The truth is, Bill, that the industry is amazingly tenacious. The idea that so many juniors survived the last 7 or 8 years is absolutely astonishing. It's also unfortunate. The business would profit by having many, many, many fewer listings. All that money that the industry consumes every year in G&A truly goes to money heaven rather than going in the ground. And that is not good for the industry. And it's not good for the investment community.
Rick, last year I watched a small explorer raise $1 million, and shortly thereafter they paid a promoter $250,000 of the million, which I thought was outrageous. So what I did was look at the insider trading afterwards, and a lot of that wasn't reported. So my question to you is, for the average retail resource investors listening to us in this discussion right now, how could they do further research? I mean, is there any way to track that company out in the Cayman Islands? I mean, it didn't make any sense why you would spend a quarter of your raise not putting it in the ground, but on paying a high excitement, rev it up type promoter.
I don't think you need to do additional due diligence. The management team has shown their intention. From their point of view, the highest return on capital employed is paper. Not exploration. It shows that that company is a construct. It's not an exploration vehicle. It's a paper construct. And while it might be interesting or amusing to do further due diligence, I think it's a waste of time. You already have the answer in your hand. If they raised $1 million and it costs $500,000 a year to keep a public company alive, and then they spend $250,000 on promotion, what it says is that they believe that their exploration potential is worth about $250,000. Now let's assume just for a second that that company has a $10 million market cap. It has a $10 million market cap with an expected net present value, according to management, of $250,000. Do we really need to do more due diligence? It might be amusing. It might be a way that you use up some intern's time. But really, all you need to know in a circumstance like that is the intention and the value orientation of the management team, which is to say corrupt.
I've interviewed analysts on this show, and one analyst I interviewed, his pet peeve is when management extends the options, the time period for the options. What's your take on that?
If I do a private placement, I often specify in the private placement document that if management extends and reprices their options, they have to extend and reprice my warrants. That's a lot of fun doing that, and that keeps them honest. In the right set of circumstances, where the management team, as an example, has participated in a private placement that felt like a rights offering, in other words, where they read a check, I'm willing to tolerate options repricing. But basically, the idea that somebody gets paid to underperform is, on the face of it, objectionable.
When you're looking at a recently IPO'd deal and maybe they're doing their first financing after the IPO, how long do you want to see those cheap founders shared mandatory escrowed?
I don't care, really. What bothers me more is the lift. We're seeing now these new constructs coming out. I'm not saying they're all done by bad people, but the ethos in Vancouver, as an example, seems to be that the standard is that the insiders issue themselves some number of shares, 5 million, and then they issue a so-called bargain round at a nickel or a dime. Now, when I run an investment vehicle and I charge a 1.5% management fee, and I get a 15% performance fee over an 8% hurdle, people say it's egregious. But these guys are marking up their paper 400 or 500% out of the gate with no hurdle. This is truly insane. The idea that they made themselves a bunch of stock at a penny and they're going to do me a favor by selling me some at a dime? What kind of favor is that? It's 1,000% lift. I would urge all of your listeners to employ arithmetic as a substitute for narrative when they're looking at these newly minted companies. A guy will say, well, this thing is cheap. The market cap is $5 million. Okay, what do I get for $5 million? $750,000 cash, a property that they bought for $100,000, and the right to lose $500,000 a year in G&A. How much should I pay to lose $500,000 a year? Should I pay $5 million? Should I pay $10 million? What is a cheap way to lose money?
The opposite company to a company you just described is a royalty company, and I was going over our notes, and at the last PDAC a year ago, you mentioned you were deploying capital into the royalty companies. So I've heard some people say that they think relative to the sector as a whole, the royalty companies are overvalued. What would be your response to someone like that?
They're right, but they're still cheap in an odd sense. If you have an industry, that first of all destroys capital, like the mining business, but if you take a better part of the industry where the return on capital employed over the last decade is sort of 11, 12, 13%, and you compare that to a royalty company that is earning 80 or 85% margins, you would pay more for an 85% margin business than you would a 15% margin business. I mean, it makes absolute statistical sense that you do that. What is going to be problematic now with the royalty and streaming companies is that they've enjoyed so much market favor that everybody is starting them. And the ones that are coming into the business now do not have the advantage of a low cost of capital like Franco or Wheaton. They don't have a deep pipeline like, as an example, Sandstorm. They're Johnny-come-latelys. There are people that are starting royalty and streaming companies because it's the only way they can raise money. And the fact that there's probably 10 or 15 in the process of being minted today tells you that competition for the very low end of the royalty and streaming business, which is where these guys are going to have to concentrate, is going to become ferocious. So not all royalty and streaming companies are the same. When you think about the franchise, the broad franchise is great, but remember there's no substitute for individual security analysis within that franchise.
About 3 years ago, I interviewed one of your brokers, Steve Todoruk, from my show, and I remember talking to Steve pre-recording, or it could have been after the recording, and I brought up somebody who made a discovery, and they had launched a new company, and I remember him being adamant, advising me, just because they were successful once doesn't mean they'll ever be successful again in their career. How do you reconcile that truth with your truth of follow serially successful people? I guess they're not serially successful if they only have one discovery, or what's your commentary here?
Well, I think what he said in its own way validated what I said. There is no guarantee that anybody's going to be successful. Remember that the odds of success on any individual exploration effort are low. But the truth is that there's a greater probability of success. What he said is true. There's no certainty. There's no certainty in investing. In fact, no certainty in life. So what he said is true, but what I said is more true. If you look across the length and breadth of the exploration business, what you find is thousands of people that will unfortunately never in their life enjoy success. You find another group of people, sadly much, much, much smaller, that are successful four times or 5 times or 6 times. When somebody has been a success just once, they get exposed to a virtuous set of circumstances. The consequence of their success, first of all, leaves them well capitalized. So they can write a big enough check to own a lot of their company, which is motivating in and of itself. But secondly, their reputation lowers their cost of capital relative to other people, which is virtuous. It increases their access to intellectual capital because they're known as winners. And the people who would go to work for them see that their cost of capital is lower. And it gives them a broader range of opportunity to acquire properties for the same reason. So what Steve said is true. There's no guarantee of success. But this is a game of compound probabilities. One success itself gives somebody a substantial leg up over their competition. 2 successes begins a franchise, and you end up over time finding people like Bob Quartermain, Ross Beatty, Clive Johnson, the Lundins, who have been serially successful. And from my own experience, had I spent the last 40 years just hanging around 5 or 6 people that I already did business with 40 years ago and not bother with anybody else, I would have worked 10% as hard, and I would have made 3 times as much money.
As we look forward to the rest of 2020, Rick, what key advice would you want to leave with the listeners of my show?
Well, the first would be a replay. Pay more attention to arithmetic and reality than you do to narrative. The narrative part is fun. Arithmetic works like this. If you own a stock and you think a stock is fairly priced at $1, nothing changes in the company except the market's good and the stock goes to $2. You like it. It makes you feel smart. You look at your statement. And the fact that it went from $1 to $2 verifies the narrative. But the truth is, if nothing has happened in the company and the stock goes from $1 to $2, it's arithmetically exactly half as attractive. Conversely, if a stock that you think is worth $1 falls to 50 cents with no change in the underlying fundamentals, you hate it because you're down 50%. But the truth is that stock is precisely twice as attractive in an arithmetic sense. It's difficult to make your mind wrap itself around the delta between price and value, but to make money successfully over time, that's something that you have to do. The second thing that I would say is after 10 fairly hard years, I think people need to wrap themselves around the fact that we're coming into some pretty good years. First, probably in the precious metals, where I suspect that fiscal policy, among other things, means that the metal will do well, and over time the shares will catch up. I believe that we're headed into a bit of an economic slowdown, and I had expected that the consequence of that would be that base metals and industrial materials would drift lower over time. The current circumstance that we find ourselves in with this bug, the coronavirus, means that 2 or 3 year grinding decline may be forward shifted. We see as an example today about a 2.5 million barrel a day shortfall in oil demand, primarily out of China. And the oil price falls from $60 to $45. The nice thing, if there can be one, about this threatened pandemic is it might bring base metals and industrial materials down to the price where they're really, truly, stupidly cheap. So it could be that we could, as a group, enjoy a 2 or 3 or 4 year bull market in precious metals, and maybe 1 or 2 years into it, the recovery, the beginnings of a bull market in industrial materials. I'm not saying that's going to happen, but the idea that we face a bull market and then a bull market is, at the end of my career, which is what I'm at, an extraordinarily pleasant set of circumstances to look forward to.
You've been listening to the one and only Rick Rule with Sprott Global USA. Rick, thanks for joining me.
Always a pleasure. Thank you.